Great. So for today's section, we are going to look at capital budgeting, popularly known as what? Investment appraisal. Capital budgeting, popularly known as investment appraisal. Good. So that's what we are going to look at for today. Capital budgeting. Capital budgeting or investment appraiser. Investment appraiser. Perfect. Now, when you talk about budgets, making decisions ahead of time in monetary terms. Good. Before we start this one, we build it on assumption that before you go into any business, any venture, before you buy any assets, you need to appraise such investment, such project, and see that financially the project will sound good. So financially, if it is viable or it sounds good, before you can go ahead and go into such business. So that is all about investment appraisal. Now, a clear distinction have to make between these two terms: capital expenditure and revenue expenditure. Now we give example. Over here, we are going to expand it. We said that capital expenditure, according to IA 16, is when you buy new non-current assets or you improve existing assets. Good. Under this topic, we are going to expand that definition. So, capital expenditure simple means we are adding one to it. First, buying new non-current assets. So, new what? Non-current assets. Second, improving existing non-current assets. The last one that we are adding, this is what we know under IA 16. Over here, we are adding entering into new business. Entering into what? New business. So this is the capital expenditure. So the amount that you incur or the capital cost of entering into new business is termed as what? The capital expenditure. All the capital expenditure, you capitalize it, should be on the balance sheet as an asset. Revenue expenditure is expenditure other than capital expenditure, like to cater for your operating costs, and then expenditure that you incur to run the business on daily basis, or incurred on assets to maintain the even flow of the economic benefits. So that is it. So that's the capital expenditure. Now, at the end of every year, if you are budgeting for the project that you are going to undertake for the following year, then there's a need for you to appraise it first before you include it in your budget. Good. And we are saying that we are looking for the capital projects. So here, most of your questions will be like this. We are going to buy new assets. On what basis should we buy the assets? Should we go ahead or we should stop the acquisition? We want to introduce a new product or go a new area or a new line of business, portfolio management. We are adding more portfolios, more products and services. Should you go ahead? Maybe your branch, they want to add new service or new products to their customers. So on what basis should you go ahead? It's not every product, not every good product that can sell on the market. It's not every good product that can generate return or money for you. Yes. So before you finally take that project, you have to appraise it and see whether financially it sounds great. So appraising a project so that financially you determine whether to sound good is what we term as what? Investment appraiser. Basically, that is it. So that is the intro about the investment appraiser. Now, before you accept any project or you enter into any project, there are two items that you normally consider, and based on it, you accept the project. So first of all, you consider one, the return, and two, the risks involved. The risks. So return and then the risks. So basically, that is what you are going to consider. When you talk about return, what are we looking out for? When we talk about return, so here we are saying that before any project or before you enter into any project, you make sure that the return is what? Suitable. The return is suitable. Like you like the outcome in terms of the profit or the benefit that you are going to derive from that project or that investment. The return must be suitable. Then the risk must also be what? Acceptable. You know, everyone and its attitude or appetite for risks. Some people like risky ventures or sections because the higher the risk, higher the return. Yes, they move together. So that is it. So take note of that. So when I ask you to explain the basis on which capital project will be accepted, we coin it around what? The return and the risks involved. That is all. Return and what? Risks. Suitable. Return must be suitable enough. Risk must be acceptable within the range. Good. Then from there, we look at the steps in the capital investment process or the investment appraiser process. So let's quickly look at the steps involved. So if you want to enter into new projects, what are the steps? Is it that when you get the money, no, then you are investing at this area, this venture? Yes, because the funds are idle. You have to put them to alternative use. No, let them be idle. If you're not going to get suitable return, let the funds be idle. Why? Because if care is not taken, you rather go and then exhausted there without having any return. In fact, the capital in itself will not be recouped. So take note of that. So what are the process that we have to go through in the capital budgeting process? It's a bit straightforward. So first, the step one, make sure that the capital investment process is in line with the company's objectives. Make sure that the steps is in line with what the company's objectives. That's the first step. So the steps, number one, make sure that the proposals are in line with the objectives the organization. That's the step. Very first one. Or the strategy. Each and every company and then their objectives and then their strategy. So make sure that whatever you are going in is in line. That capital investment proposal is in line with the company objective. Some company they vow to themselves that they will not enter into certain area. So before you appraise the project, make sure that that project is in line is what like the company's norm. Your culture support it, your system support it. Good. Because every year its own agenda. So if this year our agenda is not on capital budgeting, then it means that it does not fit well in the strategic position of the entity. So such project, we are not going to even evaluate it at all. So before you start the evaluation, make sure that whatever project, whatever business, it fits well within the strategic position of the organization or the strategic objective. Maybe the organization's objective is on one way and then the project is on the other side. No, it creates issue. Okay, so that's the first step. Then second, you have to forecast relevant cash flow to the project. So step 2, relevant cash flow to the project, forecast. So forecast or predict or estimate relevant cash flows to the project. Relevant cash flows to the project. Now, after you have successfully analyzed whether this project is in line with the company's objective, then you go ahead and now you estimate the likely return and then the amount that you are going to spend on the project. Now, when you say cash flows, there are two. We have the inflows and what? Outflows. So like as we did in the cash flow statement. So the same thing there. So all the monies or the receipt one side, all the payment one side. That is all. So that's the second step. Then step 3, you do the evaluation. That is where we have the types of evaluation methods. So evaluate the projects. Evaluate what? The project. Evaluate the project. So that is the step 3. After the evaluation, sometimes the projects are not just one. We have 3 business that you want to enter into it. You evaluate and then implement the best one. So after the evaluation, the end results will tell you whether you should enter into such business or you should withdraw your intentions. And all depend on the final outcome of what? The evaluation. Good. Then from there, you go to the next step. Then the next step is that you now implement the project which satisfied the company. So the one that satisfy all the criteria, implement that project. So the one that after the evaluation, it was successful, implement it. So that is the next stage. So step 4, after the evaluation, select the best ones that met all the criteria. So step 4, implementation stage. Implementation stage. So please, before you enter into any business, any project, a friend of yours comes and okay, There's some business that has heard of it that people are doing it. Want you to go and then join. Just sit him down. Analyze that business. Does it fit well within your soul, like your interest? Does it fit within your objective? Is that what you are aiming for every day? If it doesn't fit, boycott it. Don't even try. Because you have your agenda. And then if you enter into it and then there's an issue, you're going to blame him, right? No, don't do that. You have to blame yourself. Okay, so don't even enter into it. That's the first step. Second step, ask him to tell you everything about the project so that you can use it to forecast. So what do you get? Okay, you get 5,000. What do I spend? You spend 4,000. So return is 1,000, right? Okay, 1,000 is okay. I'll manage like that. Let's go. Then let's implement it. You now start the main issue. Now, right after the implementation stage, then you go to the last stage. You have to monitor the progress because you just need not to invest your money and go and sleep. And that's what happened to the men's goods. Yes. If you are like monitoring the investment, at the time that you hear any news, all your investment must be withdrawn. You won't be a victim. But if you invest and you don't monitor your investment, you might not get the actual return. So the last stage of the process is what? Monitoring the performance of the investment project to ensure that it's in line or it's performed in line with what expected. So the last stage is what you have to what? Monitor. So monitor or the monitoring of the projects. So don't go and just invest your funds. They also use it. They also use it. So just be monitoring your or monitor your investments. Make sure that if it increase, you are aware. If it drop, you are aware. Whatever you expected, you've gotten it. And then you are fine. If there's any query, raise it. But if you don't do that, and you still somewhere, the investment is also somewhere, then it means that you have to accept anything that will be mentioned to you at the end of the project life. Yes. So that is the process that we go through to appraise the investment project. Then we add them. Now I'll kick it from the step 3. That's where the whole issue is. So your examiner start from the step 3. How to evaluate what the capital projects, the evaluation. That's where your exam questions will be based on the appraiser. Sorry, sorry, so sorry. So the step 3 is about the valuation of the project. Maybe the projects are many, so you have to evaluate all of them at this stage. Those that will qualify, do them. Those that will not qualify, throw them away. Yes. So now your exam question is centered on this area. That's all. This area. That is all. How to evaluate, how to appraise the project, how to analyze or assess the project and see whether this project will be very good. This project will be very bad. If you do it well, that's what you're going to get. Oh yes. So that is it. So let's start with the appraiser. We have the techniques. All what you need to know is what are the various evaluation methods. How do I evaluate this project? What are the techniques that are available to me? That is all. So we write the techniques down. Then we will look at them. At least we look at the first 2 today. First 2 today. Then the next 2, another meeting to end investment appraiser. So the techniques are the appraiser methods. So investment appraiser methods. investment appraisal method. So investment appraisal method. Appraisal methods. You should know all these methods. That is all. The first on the list is accounting rate of return. Accounting rate of return, properly known as what? ARR, or return on capital employed. Return on capital employed. That's the name we'll see. Number 2 on the list is payback period. Payback period. Using payback period. Then number 3. Number 3 is like a cluster, like a group. So we call them discounted cash flow techniques. Discounted cash flow techniques. Discounted cash flow techniques. Good. Over here too, there are 3 in number. That's all. So in all, there are 5. Basically, there are only 3 or 4. Just that you make some. So A, we call it adjusted payback period. Wow. It's called adjusted or discounted. The word adjusted also means what? Discounted payback period. Discounted payback period. That is it. That's the first one on the list. Perfect. Then B, almighty. Net present value, NPV. Net present value, NPV, almighty. Net present value, NPV. Then the final one, C, we call it internal rate of return. Internal rate of return. So internal rate of return, properly known as what? IRR. That's all. So if you know how to appraise your project using this method, that's all. When you flip. That's all what we need. The advantage, disadvantage, that's all about the capital investment budgeting or capital investment appraiser. So that is it. So we start one after the other. So by the end of the day, we should be able to clear this guy from there. Yeah. So that in a subsequent, if possible, add this one, this and this one just pay back, adjusted pay back, and then that is all. So accounting rate of return. You're welcome. Accounting rate of return. So we go to each of them one after the other. If you pick each of them, you should know 3 items. Number 1. If you pick each of them, 1, you should know the advantages and disadvantages. So that's the first one. So advantages and disadvantages. Number 2, You should know how to calculate the calculation of it. And number three, you should know the acceptance criteria. Acceptance criteria. So these are the section. So if you pick account rate of return, you should know what it is, advantages, disadvantages, how to calculate it, how do you now use it to appraise the project based on the acceptance criteria. So that's all. Okay. So accounting rate of return, you're welcome. So accounting rate of return, ARR. Now, under this method, the project will be appraised based on the average rate or the average profit divided by the investment. That is all. So if we go straight and then talk about the formula. Now this method, we use profits. We use accounting profits. We use what? Accounting profits. So take note. To evaluate the project, so we use accounting profits to evaluate what? The project. That's all. Accounting profits to evaluate the project. Great. So let's quickly look at the formula. The formulas are two. Any of them, it's okay. So as a result of that, the examiner normally states the formula that you should use. Or if you don't state, use the very first one. Okay, so let's look at that one. So the formulas are the account rate of return. If you want to calculate it, you can go by the split steps. So formula one, ARR is equal to average profit or divided by average investment times 100. That's the first formula. The account rate of return is the average profit over average investment times 100. That's the first method. Method two. Method two. Accounting rate of return is equal to average profit over initial investment. Not average investment, initial investment. So these are the two acceptable formulas for average or for the account rate of return. Take note that the bottom line is this one, it is what? Accounting profit. That's the good news about that. Now, where in all cases, average profit is equal to total profit divided by the number of what? Years. The project life. So useful life of the project, or the lifespan of the project. That is it. Now let's go to average investment. The formula for finding average investment. So let's look at the formula for finding average investment. The average investment is equal to the initial investment plus the scrap value, all divided by 2. If there's any working capital, you add it. So let me write the formula here. Let me see where I can write the formula. So let me write it here. B, average investment is equal to the initial investment plus the scrap value. All this divided by 2. Now, that is the average investment. Is initial plus the scrap value, all divided by what? By 2. Multiplied by 2. In fact, this one too is times 100 though. All of them times 100. Now here plus working capital. If there's working capital in a question, plus the working capital. So take notes of that. Times working capital. So it should be scrap value plus the working capital. Let me find somewhere to put the working capital plus working capital. So that's the average investment. So let's quickly back with what? With illustration. Let's quickly back it with illustration. So I'll pick some illustration from the material and go straight and then solve it. Okay. So let's see. Now the only issue is this. Here we said we want accounting profit, not cash flow. And from IA7, profit is not equal to cash if I'm using the accrual basis. So cash flow and profit are different altogether. So it may be likely that they will give you the cash flow. So when they give you a cash flow, you have to convert it to be what? Profit. So when they give you a cash flow, kindly convert that one to be what? Profit, or into profit. How do you convert cash flow to profit? Item that has not been taken into consideration is non-cash items. So depreciation has not been subtracted. So calculate the depreciation and subtract it from the cash flow to arrive at what? Profit. Please and please again, accounting rate of return uses what? Profit. It does not use what? Cash flow. So that is it. So now let's back with what? An illustration. Then we look at the acceptance criteria of it. So now this is a formula. We look at the importance of the accounting rate of return. So let's pick some few illustration. But before that, we will look at the acceptance criteria. We call it decision rule. So if you calculate on what basis are you going to accept the project for an account rate of return. Now, each and every company have their own targets. Okay, we here will not accept anything less than 20%. Don't worry. Put it down. You should have a target. Put a target down and go into the actual project. at the end of the project life, calculate the account rate of return. If you get, let's say, 18, the project must be rejected. Yes, because we're not able to meet what the target. So let's quickly look at the acceptance criteria. Then we pack it with the question. Then we come and then pick the advantages and disadvantages, and then we are done with accounting rate of return. Just normal. So let's look at the decision rule or acceptance criteria. Decision rule. So after the calculation, on what basis do you advise the company they should accept that project, or they should go ahead and invest in that project, or they should stop? On what basis? Now we have for a single project, and we have for what? Multiple projects. We have for single projects and what? Multiple projects. So take notes of that. When you talk about single project, it's like just one project. You are not going to compare to any other project. So for single projects, the decision rule will be accept the project that have account rate of return greater than the target or the minimum ROCE. So the decision will be accept project with AAR, that's ARR, project with AR greater than what? Target. Yes, anywhere I see my name, I write it in capital letters. Please write it in small letters. Greater than the target or the minimum proceed. Great. So the target or the minimum rate of return. Minimum rate of return. Usually the company towards proceed. Good. So target or minimum rate of return. Minimum rate of return, which is the same as what? The ROCE, return on capital employed. How we get it? So the ROCE that we calculated it from where? The ratios. Yes, for that company. So let's assume that you calculate a single project. You had like 18%. The company, their ROCE is 20%. Now, ROCE simple means return on capital employed. That one is the company as a whole. So the whole company, their return is 20%. Then it means that before you accept any project, that project must earn more than this 20%. That's the bottom line. So if the company, we have taken people's money and trading with it, and then the return that those people are getting, the capital that is employed, a 20%, then this project must pay us more than that 20%. Other than that, we won't get money anywhere to pay the people. So that is the acceptance criteria. So that means in a question, they will tell you the minimum ROCE or the target rate of return. So that after you calculate, you compare and select what? The highest one. That is the acceptance criteria. We are done. Then we have for multiple projects. Multiple projects. That means you have several projects that you want to analyze. On what basis do you select? You have to select the project that with the highest what? Accounting rate of return. So for most projects, still select the one that with the highest. But again, it must be what? It must be more than the minimum or the target ROCE. It should be higher than the minimum or the target ROCE. Take note. So like you should have an expectation. That's why for every job interview or a business, they ask you, what is your expectation? What is your expectation? And you start quoting figures that you have no idea. Yes. What's your expectation? So that if they don't satisfy your expectation, they know that they are not going to win you. You will go. Because if you are quoting like let's say 7,000 to 10,000 a month, and then in fact in their budget they are quoting 4,000. 4,000 to 5,000, and you are quoting 7,000. In fact, they will reject it because their target will see far, far, far below what you are quoting. So that is it. Now we will pick illustration question and do justice with it. So take note. So let's go to the material to pick illustration question. This time I want to move fast, so I'll pick my material questions from the material. And this have been uploaded on the platform. So kindly get and then get the hard copy of it. Okay. Okay. So everything is there. So kindly continue and do the further reading about it. Let's get straight into business. Account rate of return. Many have been said about it. And one thing, the difference between account rate of return and ROCE. Who will tell us? Difference between account rate of return and ROCE. So account rate of return, that one is specific. ROCE is not specific. Account rate of return is what? Account rate of return. That one to a specific project. For ROCE is for the company as a whole. So take note. ROCE is for the entire company. Great, as you see here. And then the account rate of return is for a particular project. So project by project. Okay, so let's go and pick our first illustration. So example one. Target publications considering a project which requires an investment of what? 450,000 450,000 cedis in a piece of equipment. The equipment will last for 5 years with a residual value of what? 50,000. The expected annual profits before depreciation are. Now, one thing too about the account rate of return, we say it uses accounting profit. We want profit after depreciation, but it must be before interest and tax. It's operating profit. So profit before interest and tax, but it must be afterward depreciation. So take note. So this one, the examiner said is before depreciation. So we just have to now look for the depreciation, take it off, then we are done. So that is it. Now, yeah, the profit are there. So let's see. So he's saying that target requires a minimum accounting rate of what? Or the target ROCE of 26% from projects of this type. So if you calculate you don't get more than 26%, they should reject the project immediately. Account rate of return is measured as what? Average annual profit as a percentage of what? Average investment. This examiner is very good. Yes. Yes, inform us which method you should use. The first, here is the first one. Good. So that is it. The secret is that where we have the scrap value, if there's a scrap value in a question, then use the first method. If there's no scrap value in a question, then use the second method. You are done. That is it. Should the project be undertaken? Advise the company. So let's go. So first, we are calculating accounting rate of return. Let's go to the board. So let's go to the board. We are calculating accounting rate of return. So let's set the tone. We go by the long approach and then the shortcut. Accounting rate of return. Just put the formula for us nicely, and then you are done. First, I'll tell the examiner that I'm calculating what accounting rate of return. So accounting rate of return, which is equal to average profit over average investment. The more I read the formula, the more I remember. Times 100. Then I come and set the tone. They have given me years up to sum all the profits. So I write here year. This profit is before depreciation. And I write depreciation here. But I think subtract should work here. Then profit after depreciation. It was how many years? Year 1, year 2, year 3, year 4. And year 5 too was there. Okay. So let's see. So let's go and pick the profits. 160, 140, 200, 125, 160. Okay, so the third one is 200. The third one is 200. The first one is 160. The last one is also 160. 2 and 4. Okay. 2 and 4. One of them is 125. 125 and 140. So 140, 125. So 140, 125,000. Okay, so that's the first section. Then you go ahead and calculate the depreciation. What's the cost of the equipment? Let's go and bring the cost details. Cost of the equipment is what? 450,000. Scrap value is what? 50,000. Okay. So the scrap value is 50,000. So what will be the depreciation per year? If they don't tell you anything, use the straight line method. Sometimes you'll be informed which method. If they don't tell you anything like this, use the straight line method. And the method will not affect the final answer. Whichever method I use, the final answer will still be the same. Okay, so let's go there. Now, depreciation workings. Depreciation will be 450,000. Now minus 50,000, right? That's the scrap value. All divided by number of years, 5 years. So please, what's the depreciation charge for a year? that means you take 80,000 from each year's profit. So put it in bracket. 80,000 minus 80,000. But they have not subtracted depreciation. So we are just calculating profit. So how you calculate profit? Sales revenue, cost of sales. It must be the same thing. How you calculate your profits before interest and tax, the same thing that we are doing here. Okay, so what will be the profit after depreciation? 160 minus 80, so that would still give us 80,000. Here to still give us 80,000 because they are twins. 140 minus 80, that will give us 60, right? 200, that will give us 120. Agreed. Over here will give us 45, right? Perfect. Then you put a total. So what is the total? So what's the total? You sum the total up. Then you get the average profit. So average profit. Okay, so the total will be 80,000 plus 60 plus 120. So that's 260, 280, 325, right? Like summing the profit. These sections down. This what do we? So the average profit will be, if the total that we got is 385,000 on average. So average profit, you divide this one by what? The number of what? Years. So the average profit will be this figure divided by what? 5. So 385,000 divided by what? 5. So you can open a bracket here. That is number that is 385,000 all divided by 5 years. All divided by 5 years. So here the average profit is 77,000. Perfect. Then you continue the game. Please, this is a long approach. What you've done to get this 77 is a very long approach. Not long per se, like consume time. So what's the alternative? The alternative is that when you start with the average profit, so alternative for just for how to get this 77 alternative. So you start writing your year. You write your profit, that's all. So 1, 2, 3, 4, 5. So write original profit 160,000 from the question. That's this very figure. All these ones. The next one is 140,000. The next one is 200. The next one is 125. The next one is 160. Then you sum it up. So you just sum all the profit that you have here up. You sum all up. So that will give us something like 785, right? 700 and what? 85. Great. Then you subtract the total depreciation, which is same as the depreciable amount. Then this is the total profit. Then depreciation, total what? Depreciation. Here is the depreciation charged by per year multiplying by the number of years. So if it is 80 for just a year times 5, or to be on safer side, do not even waste your time to calculate the depreciation. Don't waste time to calculate the depreciation. The total depreciation is the same as the depreciable amount. Who will tell us? The total depreciation is the same as what? The depreciable amount. The amount that will suffer depreciation is nothing but the cost, which in this case is 450,000 minus the scrap value of 50,000. So take note of that. So here the cost is 450,000 minus 50,000. So that means the total depreciation will be what? 400,000. So that if you take the total depreciation from this, you get 385. Which is the same as this. Then now average profit continuing from there. So this is the total profit after depreciation. Then average profit continues. So basically this is a shortcut approach. So it means that if you sum all up this, you just have to subtract the depreciable amount. Is your cost less the scrap value. So let's continue the game. So you select the best one that you like. I'll go in for the second approach. So now let's go ahead and calculate the average investment. We said that the average investment is nothing by initial investment plus the scrap value all divided by 2. Okay, so let's basically continue the game. So I'll continue from this angle. So I'll continue by saying that average investment so here I'll open a bracket. What is the initial investment? It's 450,000 plus the scrap value. What's the scrap value? 50,000 all divided by 2. So what do you get? So that will give us 250,000, right? It's continuation, so to be under this. So we are done. So therefore, the accounting rate of return will be average profit of 77,000 all over average investment of 200 and good. So that is the end of the game. So 30.8%. So should they accept this project? Should they undertake the project? Should they go ahead and buy the equipment, or they should stop? If yes, why? If no, why? So should they go ahead? So because it's what higher than the target rate of return. So the return is higher than the target. So that the target will see. Okay, wait. So I'll take that. Okay, so the first important. Let's now consider the importance of the accounting rate of return. The very first one on the list is it uses accounting profit. So the accounting rate of return is what? Accounting profit, which is in a way so easy to get accounting profit. Now, getting accounting profit or estimating accounting profit, it's a bit easier than estimating cash flow. Right. So this is accounting profit. Then number two, it is easy to calculate. Then we look at the disadvantages, the challenges that we have. So the challenges of accounting rate of return. The we've mentioned three here. One, the advantage is one, we said that it uses accounting profits. So the principles are familiar. Yes. How you estimate accounting profit, we are a bit conversant with accounting profit and the cash flow. 2.2. Let's jot them down. Two. The one which says uses accounting profits. Two, we said that it is easy to calculate. Easy to do what? To calculate. Easy to calculate. And then fairly, it's easy to understand. So you can just measure them. If it's easy to calculate and what? And then understand. You can break them, make this one three, and then make this one two. All of them are coming from the same point. So long as it uses accounting profit, it makes it easy to calculate or easy to understand. And then we are done with the key with the key advantages. Now let's go to the disadvantages. Now the disadvantages, here we said that it uses accounting profit but not cash. It uses accounting profit but not cash. Like the same point is also a disadvantage. The disadvantages of this, number one, we are saying that it uses what? Accounting profit but not cash. Good, but not cash flow. And then since the accounting profit can be manipulated with the subjective accounting policies, so it uses what? Accounting profit, which can be what? Manipulated. Good. Then you go to number two. We said that number two, it ignores the timing of the cash flows. It ignores the timing of what? The cash flows. So take note of that. The timing of the cash flows. Here we will say the timing of the accounting profit, not cash flow. Timing of what? It ignores the timing of the accounting profit. So accounting profit, the timing, it doesn't care whether probably you had that cash flow or that profit at the start or at the end of the year. So that is it. Then you go to point three. Now the accounting profit is a mere percentage. So the account rate of return is a percentage of return. Now it does not determine the absolute returns. It does not determine the absolute returns. So it's just a mere percentage. This one is 30%. And so what they tell us the monetary version, no, the absolute. So what does the 30% represent? So that's the accounting rate of return, the disadvantages. So basically, that is the few challenges that we have. More are stated in the material. Then move on. We can add number 4 to it. Number 4, we can say that the accounting rate of return does not take into consideration the risks associated with accounting profit. So risks is being ignored. So we don't consider risks. Accounting rate of return does not consider risks. So accounting rate of return does not consider risks. So we are done with accounting rate of return. Let's see if there will be a trial. Great. Let's see if there will be a trial. Now let's look at this. Let's go and pick this one. We've done this one. Okay, so let's continue the game. So that is the end of the accounting rate of return. The summary is that it's based on what? Accounting profits. And accounting profit, you all know how to arrive at the accounting profit. That's operating profit. Its equivalent is the profit before interest and tax. Profit before interest and tax. Great. So now we are moving on to payback period. Payback. Period. Payback period. But before that, have you seen the question that we solved? The question that we solved. So assuming that you are using this particular question to calculate for the accounting rate of return. Here, this is cash, net cash receipt. So this is a cash flow. You know, accounting rate of return, we don't use cash flow, we use profit. So find a way of converting this cash flow into what? Profit, and then use it. How do you do it? Just subtract depreciation, that's all. So calculate your depreciation and subtract it. So it's the same as you finding the total and subtracting the depreciable amount from it, and then you are done. So let's take note of that. Great. So now we can go to our payback period. Now, payback period. Here we analyze projects, or the payback period is just the duration that the project will pay back the capital investment. How long will it take you to recoup your capital investment? That is the payback period. How long will it take the organization or the project to pay back? So, how long? Well, the project pay back the capital investment. Capital investment. That's all. So if you have used your 60,000 to invest in a project, where every year you are earning 20,000. So that means roughly exactly 3 years you get your money back. You get your 60,000. Exactly 3 years, you get your 60,000. Great. Good. So that's the payback period. How long it takes you to pay back your capital investments. Okay, so now let's see. So as usual, we will look at how to be calculated and then look at the decision rule. So let's look at the decision rule. Decision rule of payback period. As usual, all the decision rule we have for single project and multi. So take note, single project and multi. For single project, you accept the project that can pay back. So long as that project can pay back, we should accept it, irrespective of the year. If this project can pay back 10 years time, 20 years, 5 years, 3 years, 6 months, we should accept it. So single project, accept the project that can pay back. So accept the project that can pay back. That is it. Accept the project that can pay back. What about multiple projects? Maybe we have about 4 to 5 projects that you want to enter into it. So that one for multi, accept the project that would what least payback period. So accept the projects that way project with what the least payback period. Project with the least payback period. That's all. So that is it. So it seems like the project cannot pay back, we don't enter into such projects. You cannot recoup your capital investment. Don't. Okay. So now let's pick small illustration to look at. Now for payback, it uses cash flow. Payback uses what? Cash flow. So take note, cash flows. Now, by now or up to this level, we know the difference between cash flow and that of profit. These two. Accounting rate of return uses profits. Payback uses what? Cash flow, but not profits. Good. So take note, it's likely that when you are calculating the accounting rate of return, they will give you cash, what you don't need. So you have to adjust it, massage it, less the depreciation. It will give us a profit. Good. So when you are calculating payback too, it is also likely that they will give you what? Profit. They will also give you profit. Meanwhile, you don't like profit. You want what? Cash flow. So check the question. Whether what you want to solve the question has been given to you. Kindly check the question. Whether what you want is there. Not what they provided, you are going to use it to calculate. No. Check whether what you want to solve the question or what you need to solve the question has been provided or given to you. So it's likely to give you profit. Down to you massage it. Add back the depreciation to it. And it will give you what? Cash flow before you use it. So these are the issues that we have to look at. It's critical. So all the same, what we're looking for is cash flow, not profit, and the payback. If they are giving you profit, add back the depreciation. That's all. This one, it's considered the time value of money. So the depreciation for each of the years must be added back. Then we add them. So let's pick a nice illustration. When we are done, we look at the advantages and disadvantages as usual. So payback, that's example 2. So you try this very one. Your trial number 2. You will use this question to calculate what the payback period afterwards, after when we are done. So should the investment be undertaken using payback period? So here to target publication is considering a new project requiring a capital outlay of 140,000. On equipment, an investment of 20,000 working capital. The project will have 4-year life with an estimated residual value of 5,000 cedis. The project is expected to earn the following net cash receipt. That's what we want to pay back. We want cash, not profit. So thank God they have given us cash flow. So I'll go ahead and use it without having any issue. But assuming that this is profit, that means they've subtracted the depreciation, and I'm looking for cash. So what do? I reverse it. So I have to reverse the depreciation by adding it back. So that is it. So to calculate the payback first, so tell the examiner that you are calculating on payback period. Start with your year. Start with your cash flow. And then write your balance. Please and please again. Payback period, we start with year 0. And I have to explain the meaning of year 0. Year 0 means now. The time that you invested. So you are now estimating whether to invest in that project. So at the start, the initial stage of the project is a year 0. So today, now is a year 0. That is where you are doing your calculation and see. So now is a year 0. Then 1 year time, the 1 in that order. So year 1 going. So start from year 0, year 2, year 3, year 4. Is it year 4? 4 years. Let's see the question. Yeah, it's 4 years. Then the cash flows are, now what happened is this. Year 0, the cash flow that goes there are the capital investment. Because I believe strongly that if you want to enter into taxi business, you need to have the taxi first before it will be viable. So that means year 0, the first day you have to get a taxi first, then before you start generating money. So the year 0 always contain the capital investment. So take notes. So put the capital investment at year 0 and put it in brackets. So what's the capital investment? So let's go and pick the capital investment. Here they are investing 140,000 in what? Machinery. Plus working capital of what? 20,000. So the total capital invested is what? 160,000. Is a combination of what? Whatever you are investing plus working capital. Now the question is, what is working capital? Working capital is a capital that you use to run the business on daily basis. Good. So on daily basis. So that's the short-term capital. The 140 is the long-term capital. So we're looking for the capital requirements. So here I'll put 160,000 here. Kindly put it in bracket. It suggests that it's an outflow. It is what? Outflow. All outflows will be in brackets. Inflows are what? Positive. That means we are rather paying, spending. Now let's go and pick the cash flows from year 1 up to year 4. So year 1 will be 90,000. Year 2 is 48, and year 3 2 is 90. So here is 90,000, and here 2 is 90,000. Okay, and here is 48. Now year 4, when you go to the final year, don't forget that you have to add the scrap value to that cash flow. Add the scrap value to that cash flow when you go to the final year. So all the final years, add the scrap value to the cash flow. So let's go and pick that one from the question. The scrap value is 5,000 here, and that of the scrap value is 5,000. That of the cash flow is 25,000, or to give us what? 30,000. That's year 4. So scrap value should add it to what? The cash flow. So here will be 30,000. Then that's all. When you get this, you can now start again. You come here, balance. So it starts. At the start of the year, the project has not given you any money. So you still have 160,000 to be recouped. The project has not given you any money, so the balance left is still the same. So today, if you have invested 30,000 and then that project have not given you any money, you still have 30,000 to be what? Recouped or to be recovered. Then at the end of the first year, the project was able to pay you 90,000 Ghana cedis. The project pay was 90,000 cedis. So that means it will reduce whatever you've invested. At least you have recovered 90,000. So left with what? 70,000, right? Agreed. But left with 70,000. Perfect. So out of the 70,000, put it in bracket. 70,000 to at least out of the second year, you've recovered 48,000. So left with 22,000, right? Left with 22,000 for you to recover. And then God being so good, you recover them well. Here. So just put that here. The rest don't even continue again. So how do you calculate the payback period? Don't tell us that the payback period is 3 years. Why? Because in the third year, you had 90,000. And not all the 90,000 you use. You use only 22. So you have to find the average. You have to wait and find the average. So that is it. Let's calculate the payback period here. So please and please again, the payback period, we have it in 3 forms. We'll do all of them here for you. We have it in 3 forms, so we have to calculate all of them. Great. Good, so let's see. We will calculate it in 3 forms for the payback period. The first style, all of them are in years. All are in years, so years. So the payback period will be equal to where you had a full year. So it's 2 full years and something. In the third year, it wasn't up to. Assuming that here was 90,000. If the balance left here is 90, and we recoup 90, then that one is exact. So that one is exactly 3 years. We got 90 left, we had 90, so case closed. But here 22,000 left, but we had more than 22,000. We had 90,000 here. And over here, we use the whole year to recoup that 90,000. So all what you have to do is this. It will be 2 full years plus 22,000 all divided by 90. That's all. So it will be equal to this, whatever you picked, 2 full year one side plus whatever you pick from this. Don't forget that this one is 90. It's not 22. So you pick 22 out of the 90. And you have used the whole year to earn this to 90,000. So if the whole year is 90, 22 will be what? A portion. And that's all. So what will be the answer over here? So over here, we will have something like 22 out of 90. So that will give us 2 point something years. 2 point something years. Great. What do you get? So 2.24 years. 2 dot. So 2.24 years. Okay, so 2.24 years. So that means this one will be 0.24, right? So if you should show working 2 plus 0.24, so finally 2.24 years. Right here, we don't need all this. We are not doing mathematics here. So take notes. Now we are not doing mathematics. No mathematics here. So the answer will be what? 2.24 years. Perfect. That's star one. What if I want some in years and months? So they can ask you to leave some of the answers, some are in years and what? Months. How do you calculate that one too? Still, 2 full years plus, now this time around, this one will be 22,000 all divided by 90,000 times 12 months. Times 12 months. So the answer, this one will be 2 years plus, or 2 years and, so final answer will be 2 years and something months. So 22 over 90 times 12 months. And that will give us so that will give us 2 years, 3 months. So 2 years and 3 months. That's all. Now the third one is years and days. So that one you do it for me. I want some in years and what? Days. So that's your own. So if you want some in years and days, that will be 2 years and 89 days. How? You just multiply, where you multiply by 12, just change it to 365. You multiply by 365. Okay. Good. That is the end of the game. Now, what level is we have to enter into deeper waters? We go to the discounted cash flow techniques. Discounted cash flow techniques. So I think we still have some few time. So we will still continue and look at the very first one. But before that, let me give a holiday assignment or we can try out. We have looked at example 2. So that means we are going to look at the example 3. Please, you are trying every part of example 3. That means example 3, you are calculating the payback period and what? Account rate of return. Take notes. And I need it this, I think by the close of tomorrow, it should be ready. Any appraisal techniques that uses cash flow. Now, when we take into consideration the timing of the cash flow, where exactly you are going to pay it, and that technique was examined in example 3. So if you solve example 3 critically, that issue, you will come across it and then it will be resolved. Good. Okay, so discounted cash flow technique. But before that, we've not talked about the advantages and disadvantages of payback period. And then we've not make a decision whether they should accept this project. Once the project can pay back, they should go ahead and accept it. If, assuming that at the end of, assuming that over here, you still have negative. The last year, there was some negative, maybe negative 5,000. Year 2, negative. Then it means that the project cannot pay back. Even the last money wasn't enough to pay back the capital cost. So such projects, you have to reject them. Other than that, they'll tell you that that is it. Can't pay back. They'll tell you that it's cannot actually. Now let's look at the advantages of payback period. The advantages and disadvantages of the payback period. Advantages and then disadvantages of the payback period. Now, the very first one is simple. Payback period is what? Simple. It's simple. And then easy to calculate. Simple and easy to what? Calculate. That's the first point. Now, the second point is that payback uses what? Cash flow, but not profit. These two, which of them can you manipulate? Is a profit. So the advantages or the good news about payback period is that payback period will use profit, will use cash flow, which is very difficult to be manipulated by what? Subjective accounting policies. If you have 1,000 Ghana cedis, your accounting policy, none of them will suggest that this 1,000 Ghana, record it as what? 800 or 1,002. So the good news is that payback period uses what? Cash flow. Uses cash flow, but not profit. So which are not easily to be manipulated by subjective accounting policy. Which is not easy to be manipulated by subjective accounting policy. But unlike the accounting profit can be manipulated by the subjective accounting policy. Then the third point is that payback period sometimes helps to eliminate projects that take too long to pay back. So payback period helps to eliminate project that takes too long to pay back. It helps to eliminate project that take too long to pay back. Helps to eliminate project that take too long to pay back. Too long to pay back. Then these are the three good news about payback period. Then let's look at some challenges that we have with the payback period. Now, the first challenge is that, let me ask this question. So does it mean that you are going to use this 30,000? Have you seen this 30,000? Are you going to use it? No, not at all. So the first limitation is that payback period ignores the cash flows after the payback period. Here you pick only 22 from this 90,000, the rest ignored. The whole 30,000 year for cash flow ignored. So he said that payback ignores what? The cash flows after the payback period. So this method ignores the cash flow after what? Payback period. That's the first challenge that we have with it. So why can't you use all the cash flow in assessing the payback period by just that use only few of them, or use some and then you leave the remaining ones? And two, it ignored the time value of money. Payback period ignores time value of money. It means that we don't take into consideration the time value of money. For instance, this 90,000 Ghana cedis, you are here projecting that exactly 1 year from now, you will get 90,000. And you yourself, you know that 1 Ghana cedi today is not the same as 1 cedi in a year time. So that 90,000 cedis in 1 year's time is not the same as 90,000 today. The value must reduce in today's time. That means 90,000 1 year's time will be like, let's say, around 85,000 in today's terms. So, but payback period ignores that, which is a very challenge or a very critical issue. So the time value of money is being ignored, then that is it. Then we look at the next one. Now, the payback period does not give the absolute return. However, it only gives the duration. So it's just telling us 2 years, 3 months, it will pay back. It failed to tell us the monetary value. So it does not give what absolute value of return. It's a major challenge. Payback period does not give absolute what value of return. Good. So that is it. Now, payback period can let you ignore profitable projects. Yes, payback period can let you ignore profitable projects. You want a project that can pay back quickly, like within some 2 years, if you recoup your investment. But forgetting that the longer the project, the profitable the project will be. So if you are picking project that will take, let's say, 2 years, you may end up sacrificing profitability. Because if there are two projects, after the project, the payback, you won't get anything. After the payback period, if I are going to get consistent losses. But another project, it will pay back. Let's say, let's give two scenario here for that you get it clear. Payback period can let you ignore what profitable projects. So project A and project B. Let us assume that the payback period, this one will pay back exactly 2 years. This one will pay back 5 years. So which one are you going to select? So according to payback period, you select this one. What about profitability? In terms of profitability, let's assume that in the whole year, the project life, the profit you are getting is 1,000. This one is giving you 6,000. So you may end up based on the one that will pay back short, and then you ignore the actual profitability, and that's the end of the game. Great. So we are done with the payback period. Everything about it. Unfortunately for us, this is how far the good Lord will bring us. So we will probably end here for now and continue subsequent time. But please, you are not done. You are going to continue the game. So after going through the example 3, after going through the example 3, then we look at the discounted cash flow techniques. That's the time value of money or discounting. Finding present value, future value, those stuffs. Okay. Then we look at it. Then we look at the factors or the items that falls under the adjusted payback period and then the MPV. Then we are done. Great. So thank you very much for coming. If you do have any question, kindly ask. If there are no questions, probably we might end here.